2018 has been a record year for M&A deals in the $5 to $10 billion range. A new report from EY US finds 2019 will see even more. Joining us now in a Fox Business exclusive, EY US Advanced Manufacturing Leader David Gale. David, good to see you. EY's finds that 86% of companies that claim to be affected by the tariffs plan to pursue M&A in the new year. What's behind that?
First off, Dagan, thanks for having me. It's a pleasure to be here. What we're seeing right now in the M&A market for manufacturing companies is historic. We're seeing a deconglomeration of some big companies that America was built on, and that's creating a lot of big-time M&A. That's also making its way through other parts of the middle market. And so the barometer of the 3 C's that keep the M&A market flowing, cash, both on corporate balance sheets, is private equity, dry powder, credit situation, albeit rates do seem to be creeping up. They're still at relative lows. And then the big wild card really is confidence, as everyone has seen. And the confidence is impacted by the tariff situation and trade situation. But with the fundamentals where they are, we're expecting a strong 2019.
David, are you seeing a lot of demand from abroad to buy U.S. companies? A lot of that has been stifled because of the trade uncertainty. You know, one thing that I hear overseas from China is that not only does China want trade open, but they want to have the opportunity to own companies. Do you feel like that's something that's going to happen? Are there still some regulatory barriers there?
Yeah, I think that's right. I think there are still regulatory barriers. I think what the manufacturing companies need to focus on really is what is the supply chain going to look like. We need to incorporate what trade and tariffs are, how they're going to impact the overall strategy of a company, the M&A process, but also where are goods going to get manufacturing. We might see a reshuffling of the chessboard a little bit around manufacturing companies and M&A in particular.
When it comes to manufacturing companies, what do you think is more disruptive as they try to make medium-term plans? Is it the geopolitical disruption as it relates to trade, or is it this new digital age that we're in whenever companies are having to do smart manufacturing facilities and smart apps and things that they never would have even looked at 10 years ago?
It's a great question. You know, the trade and tariffs I personally view as something that need to be incorporated into the overall strategy and M&A process. Technology is paramount, and so this is technology built into products and figuring out how to manufacture those products in the most efficient way. But it's also technology built into the manufacturing floor. And so how are we going to bring those things that we've all seen at the consumer level, the Internet of Things, AI, artificial intelligence, robotics, how are we going to get those embedded into our manufacturing process so we can do things quicker and better and cheaper?
That sounds like job losses, though.
So we're seeing a shift. It's a great challenge, Dagan, and the shift that we're seeing globally is from very focused unskilled labor force to a skilled labor force. And so we do understand that jobs are going to shift there. However, there's going to be a need for people to run the technology. And so with that shift to the skilled labor force and the shortage that we're seeing out there right now globally, it is important for companies to keep their eye on skilled labor as they're looking at M&A.
Can you share any names with us?
Names of companies
that are looking to make some deals?
It's a good question. Obviously, E&Y is based on confidentiality, client confidentiality. We've all seen in the headlines the big deal makers and
big, medium, small companies, all.
So what we're seeing right now is you read the headlines and the big companies are all breaking apart, and they're breaking apart into more of a pure play portfolio because the market's paying a premium for a pure play portfolio as opposed to a mishmash of companies that have been put together that don't have a lot of rhyme or reason.
Like what General Electric would be one that's kind of come apart at the seams.
Absolutely. See, I don't have to mention the names because Dagan took care of that for me.
Well, there are a lot of them that are split. You name a few more though that are kind of.
So in the headlines, we've seen UTC, we've seen a lot of United Technologies, we've seen activist pressure around some of the other larger companies, and that activist pressure we've seen is going to spawn more M&A. And I think it's important to note that those big companies, deconglomerations, breakup, that's just the beginning. All that's going to go through antitrust review, it's going to go through strategic review, and that's going to create more and more M&A through the pipeline.
Do you have a final question? I hear you breathing heavily.
Oh, is that me?
No, I'm just joking. I'm joking.
No. What are sort of the pitfalls that some of these companies should look to prevent, that they're not too aggressive in pursuing merger targets? What are the things to look out for there?
Yeah, I'd say one of the key things is integration. How are these companies going to come together? Is there a cultural fit? We've all seen the statistics. 48% of executives would say that they failed to achieve their synergy targets. So bringing that synergy work earlier into the M&A process is something that is paramount and can help make a deal successful.
David, good to see you. Thank you so much,
Appreciate
David Gale, EY, U.S. Advanced Manufacturing Leader. Come back soon. Happy holidays.
Happy holidays.